My speed personality are back. It's time to argue about CapitaLand Integrated Commercial Trust, to buy or not to buy. Let's go. Hi guys, Stanley here. CapitaLand Integrated Commercial Trust has just been formed with the merger of two of the largest REIT in Singapore, CapitaLand Mall Trust and CapitaLand Commercial Trust. Today, CICT is the largest REIT in Singapore and the second largest in Asia. It has an asset size of 22.4 billion and owns iconic properties like Raffles City, Bugis Junction and Asia Square Tower 2. But just because something is huge doesn't mean it will make a great investment. Today, I invited back my two split personality, Optimistic Stan and Pessimistic Stan, for a showdown on what they think of this new REIT. Let's go straight to Optimistic Stan. Thanks, moderator Stan. Investing in CICT is a no-brainer for me. CICT is now the largest REIT in Singapore, and if you're positive about the property sector in Singapore, there's no better REIT to invest in. The REIT owned grade A buildings across the whole Singapore, from a centrally located offices building, iconic shopping malls, hotel, to heartland malls that is so essential to every community that they serve. It seems almost unpatriotic not to be positive about CICT. Plus, the worst is over for the REIT in this pandemic. They have reported a sharp recovery from foot traffic of its malls, and Singapore might even be looking to reopen its border again soon. And things can get back to normal, which is awesome for the REIT as some of the malls depends greatly on tourists. On top of that, given its bigger size now, the REIT can take on more debt if necessary. This might come in useful if there's an opportunity for it to buy some distressed asset during this period. The management has a good track record of turning around a property and adding tremendous value to it. Just look at what they did with Funan and Bugis Plus. I do not think there are other REITs managers in Singapore with their track record. And lastly, the management is very proactive in helping its tenants. I know the other stand later is going to complain about how e-commerce is going to be a threat to shopping malls and blah 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 blah. But CICT management is addressing that by creating online portals like eCapital Malls and Capital Eats, allowing shoppers to buy online and even order their food for delivery. In fact, in August, the REIT reported a 10.9% of its tenant sales coming from online. And for a REIT that has so much positive and giving us roughly a 3.7% yield to wait for the recovery, what's there to complain about? Alright, even I am convinced by myself. Thank you, Optimistic Stan, for that very optimistic viewpoint. Now, let us go to Pessimistic Stan to see what he has to say. Thank you, moderator Stan. It seems our dear friend talked about everything except for the actual financial performance of the REIT. The malls has experienced a 23% drop in profit this year, and recovery is actually far from over. Even as traffic is slowly recovering, it is nowhere near the normal times. This means that business is still weak for the tenants. Over the past few months, the REIT has been giving rental relief for some of the tenants, but it is unclear without the subsidy what will be the actual occupancy rate for the REIT. To create a sustainable environment for the tenants, the only way for CICT is to start reducing its rental. And that is already happening with a 4.4 revision downwards this year for all its malls. And one of the largest property it has and the worst hit from the pandemic, Raffles City, saw a 16% reduction in rental. All its property are affected. So will the rental go back to the previous high soon? I doubt it. It could take years for CICT to see its rental go back to the normal rate. This is the new normal. Get used to it. And guess who is the largest tenant for CICT? It's RC Hotels. And that does not seem like a business that will recover anytime soon. Assuming that everything just go back to normal and CICT can continue to charge sky-high rental for its property is both naive and a little bit, should I say, too optimistic. And yes, I am going to touch on the threat of the digital revolution because the threat is real. E-commerce has taken a huge market share away from brick and mortar businesses during this pandemic. And businesses that do not have an online presence by now should be in big trouble. This is a challenge for the REIT and all its tenants from hotels to supermarket to retail and even to restaurants. If people can just buy my things online, do I really need to pay the highest rental in Singapore to showcase my product? So what will all this do to the future rental rate of its property? If the decline in rental is permanent, what does it mean to the property value of these REITs? The threat is also real for its offices, with more companies adapting to work from home schedules and there's a less need to meet clients face to face, will company look to downsize their offices? All these are long-term threats facing the REIT, and they're not going away even after COVID-19. Any prolonged decline for the REIT is dangerous because REIT has a structural issue. They are using short-term and mid-term debt to finance a long-term asset. And with billions to refinance in the next few years, it depends a lot on the willingness and ability of the banks and the debt holder to sustain the REIT. Moreover, the cost of debt for its malls now is stand at about 3.1%, but the properties are only generating a property yield of about 4%. The margin is small, so the risk is quite high. The REIT might just end up working for the bank. And unit holders are only enjoying a yield of 3.7%, so even if the yield can recover back to its long-term average of 5 to 6% in the next 2 years, the unit price might not appreciate at all. Thus, this means that the REIT is not undervalued at the moment. Why would investors risk their money with a 3+% return when the STI itself is giving a dividend of 4.1%? I would rather just buy the market and have a more diversified portfolio and get the same result. You decide for yourself. Okay, getting a little hostile there, pessimistic stand. So there you have it. You heard the viewpoint of both optimistic stand and pessimistic stand. Who do you agree with more? Share your thoughts below. Apart from CICT, we do have a dividend stock guide where we share with you 5 more interesting dividend stocks that might interest you. Remember to check it out. The link will be on our show notes below. Anyway, our name is Stanley. Till we meet again, invest safely.